Barrel rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager. I'm the senior trader for Forex Super Model. Now, I've been asked to do a series of videos on how to trade the Forex Super Model. Now, we've already done parts 1 and 2, and this is part 3, which is entitled Now We Want to Be Right. Now, imagine that your trade is this onion. It's quite a small onion, but imagine that's your trade. So that represents your trade. Right, this frying pan represents the market. So let's suppose we're long euro dollar. This is our trade, and we're on full margin. We stick it in to the market. Yeah, the market chucks it out. Okay, it's gone. That's how most people trade full margin. Right, so let's imagine again. This is your trade. This is your trade. It's an onion. Yeah, this is your trade. Now, let's imagine that you're a standard default trader with a 20-point stop. Now, this is the market now. Right, pop it in. We're going long. Bit like roulette, but not quite the same. And we're whooshing around the markets. The edge is your stop, and if it flies out, so this is your yeah, you're getting a bit of time in the market now. Some data comes out and whoosh, you're gone. Right, now imagine that this is your trade again, but you're using the Forex Super Model. Right, this is now the market. Okay, we're going to pop up and the market's going to try and shake us out. It's shaking, it's bouncing. Can it shake us out? The only way the market can get rid of this trade is by absolutely letting us tip it out. Right, so that's where we are. So, also had a fourth onion, but we don't actually need that. Right, so let's make a start. So, if you remember, so this is part 3. Now we want to be right. Right, now we want to be right. So if you remember, part 1, say long euro dollar, default trader, entry, TP, take profit, because we're long at the top, stop here, let's say, I don't know, 20-point stop, and then we've got a take profit, say, of 40 points, giving us a 2-to-1 risk-reward ratio. We've entered the market, everything's great. That's where we are. If it goes into this zone, we're happy, and if it goes into this zone, we're not happy. Right, so that was the first part. Is this you, or is that you? The second part was we said in the Forex Super Model we need to get into the so-called smug zone, and the smug zone for us is, so if we want to be long again, we have an entry, but this time if it goes up, we're not happy. So if it goes with the way we want it to in terms of our analysis, we're not happy. And if it goes down, then this is our smug zone, and we're smug because we're long and short on separate accounts. Now, Part 2 explains all this in detail, but we're long, fully hedged 100%, and we're short fully hedged at 1 unit, whatever it may be. So if it starts going, so all we've lost is the 2 spreads, and if it starts chunking down, even though our flow analysis suggests we should be long, then the further it goes down and we're not in and we're hedged, the happier we are, the smugger we are. And then at some point we say, our analysis says we need to actually get into the market on a long bias. So we actually make an entry at some point. At some point we say, that's enough, we're getting in. And we have a long bias in this case. So we're short. Well, the first thing we do is we clear our trades which are perfectly hedged. So we go into each of the accounts and clear those off. We've lost the spreads and maybe a little bit of slippage, not much if we're quick and nimble footed. And the slippage will be not always against us, it'll be on average in our favour, and then average not in our favour. So should be quite neutral, the slippage. But we're going to then, so we're out the market very temporarily, but we're saying, okay, we've recognised that the market, in this case because we're looking for a long trade, we've gone down enough in the smug phase. Now we're going to have a short trade of 1 unit again, but this time we're going to have a long trade on the long account of 1.2 units. So we're 0.2 or 20% long. Right, so let's just tidy all that up. So let's tidy it up. Now, there's a couple of questions that beg answering, obviously. First one is, what if the market initially, if that's our entry on a perfect hedge, so we're 1 short and 1 long, so that's our initial phase of trying to get into this smug phase of it going against us. What if the market actually starts to go up from that point? Well, the simple answer is hard luck. We're not in the trade in the terms of a long bias. We can reassess, but generally, as I said, if you can sum up the Forex Super Model in one word, it's basically early. But that doesn't mean we can't be right occasionally. So, on average, I'd say the models are about between 15 and 20%. 15 and 20%. The actual flows happen when we get this flow signal. So that means that we're unable to enter the trade, and if it's a short swing, it's basically hard luck. If it's a long-term positional trade, we may want to think again, but all this is for other videos. Now, so that means basically we're 85 to 80% incorrect on our entry if we go in when we get the initial signal from the modelling. So that's obviously, we're far more likely to be in the smug zone than in the correct way, because of the way the models predict. So we're looking at, it's roughly, well, it's about 4 to 1. So we're about 4 to 1 more likely to be in this smug zone, which is good enough for us, because that's what we're looking at. So let's clear that up again. So that's the first thing to say, is that if it actually starts going up when we want to be in the down smug zone, then the trade pretty much invalidates itself in terms of a short swing, because of the amount of points and so on and so forth. But let's assume that 80% of the time we end up in this smug zone, and then so that's our initial entry, and then we're down in this smug, and then, as I say, at some stage we decide, and the way we decide is worth a whole series of videos in itself, because it's actually implementing our modelling analysis for the markets. But let's just assume that we've decided that the market's gone down enough and we're going to go long. So we've loaded 1 unit short into our short account and 1.2 units long in our long account. Now let's look at what can happen then. So let's just get the two accounts going. So this is our short account, this is our long account. So we're short 1.0 times and we're long 1.20 times. Right, now obviously now we've got a 20% long bias, so we're at risk in the market. Now the risk is, as we've got a long bias here, so to say we're long, the risk is obviously that the market continues to go down even after we've had this smug phase, and then it continues to go down past our entry. So in other words, our 1.2 long trade starts to deteriorate. So we start seeing red screens, and obviously our short side will be appreciating. But because we're 20% long, we're actually losing money quicker than we're hedging it or making it. So ultimately that means that we're at risk, obviously. So I know a lot of you like to use with stops, and it's quite sensible to use stops, particularly if you've got a small account. And so let's look at this then. So if we lose from our entry when we've gone past the smug phase, so we're 1.2 long, and if we lose 100 points, so if the market goes 100 points against us, 100 points down, right, so let's suppose this is $1.20 or £1.20 a point, then we're 120 pounds or dollars down the tube on this account, but we're 100 points up on the short account at 1 unit, so we're plus $100 or £100 on this, giving us a net loss of minus $20 or pounds or euros or whatever you're using. So you can see that what we've done there is we've actually done sort of a negative leverage. For every 100 points the market goes down, if we're 20% net long or short, depending on what trades we're doing, we're looking at 20 point stops. So if you wanted a 20 point stop, you remember originally, if you're a trader, you're the default trader, and you stick in your 20 point stop and you're looking for 40 points on the up, well, you could operate your 20% stop in the same way by saying, let's go 1 unit short, 1.2 units long, and that will actually give us a 100 point swing in the market before we get to the point where we've lost the equivalent of the 20 points. Now, how do you actually do that in practice? Well, you need to put your stop for the biggest one. So this is the one that's going to do the damage because you're 20% long. So you need, if you're in whatever your entry was when you came in here, you'd put a stop on the long side of 100 points. So your stop would be on that side. Now, instead of a stop on this side, you'd have a 100-point profit take. So a TP, take profit, on this side. You wouldn't have a stop, you'd have a take profit, because that's what's going to happen to this account. If this account starts going down 100 points, you're up 100 on this account. It's just the way it works. So because the way we've set it up, so you don't need to worry about having a stop on this side, because you have a take profit. But you do need to worry about having a stop on the net long side, or the net short side if we're doing a short trade. So that's where we're at. So obviously, if the market starts going our way, then if it goes up 100 points, then we're $120, pounds, euros, whatever, up on this, and we're minus 100 on this. You don't need a stop on this side, even though you're minus 100, because you know by definition you'll be more than 100 up on this side, so you're in profit. You don't need stops if overall you're making money in that way. So what we've done then is we've created a situation where we can actually effectively stay in the market on a swing for 100 points instead of 20 points. And actually we're trading at if our standard trade size is 1 unit, we're actually trading at 1.2 units. So we're trading larger but net smaller. So that's a very useful way of trading for most people, particularly if you have a small account or large accounts. I mean, this is how we do it. We trade in this manner. But what are the advantages? Well, the problem with when you're starting out trading is that you're used, supposing you're a pound or a dollar a point, you're used to seeing certain levels of figures on your screen, because that's what you see. That's the level you're at. Now, it's how do you progress mentally in terms of psychology in trading, and one of the easiest ways is to make your trades larger. Now, if you make your trades larger in a default manner, supposing you instead of doing $1 a point, you do $5 a point. So your stop loss at 20 points before was $20. It's now $100. Now that's going to upset a lot of people on small accounts. Whereas what you do is you get used to gradually seeing bigger figures, even though you're actually trading relatively smaller. So you're trading at $1.20 or £1.20. And so you're seeing bigger figures on the board, but you're comforted by the fact that you're actually hedged off on the other side to a certain degree. Now when you get bigger and bigger and bigger, you know, I mean, if you had, like, I don't know, £1,000 as your default trade size, and you were short 1,000, you'd be long $1,200 or $12. Now, to get to that stage, obviously that's what people are aiming for, to get much bigger. But to get to that stage, you've actually mentally toughened yourself up by having this gradual process of larger trades, which by default are relatively smaller. Now, the other advantage of this is that in order to stay in a trade beyond day trades, you need to have some, like they call them swing trades for nothing. You need to have some swing in your stop. So this gives you a 100-point swing if you use this. You don't have. You can use whatever you want in terms of your stop. You could give yourself a 150-point swing or whatever you want. I mean, quite often we don't even use stops at all. But we'll talk about that another time. But so you can give yourself, bear in mind what the market's done. That was your original entry where you thought you'd have a go, and you hedged the position. And that was your smug phase, and this is your entry where you're you're now we want to be right phase. So this is we want to be wrong. We want to be wrong, and we want to be right here, from here. So the market may well have dropped, depending on, could have dropped 120, 150 points. Because we're talking swing here, we're not messing about on a day trade basis. Then your entry is already 120 to 150 points to the good. And then you're sticking another 100 points, effectively 100 point stop in there. So you're down to what, 220 to 250 points lower before you're actually stopped out of your swing trade. So when you know what you've done is you've given yourself a massive bigger chance. You're in the dustbin with your onion, and the market is trying to rattle and shake you out. And you're saying, okay, have a go, because you've got to find 220 to 250 points from where it seemed like a good idea to go in the first place. So that's basically the rationale. As I said, but we can talk about that in further in other videos. So just to summarize then, we want to be right involves that process where you've actually ridden the market down at pretty much zero cost, and then you're going in with a negative leverage style trade because you're only 20% long or short, and you're giving yourself a massive chance to stay in the trade when the market gets angry and swinging around overnight. There's information coming out, you can drive your trade through a ploughed field and out the other side. So I hope that's been useful, and part 4 is in the tube. Thank you very much.